Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, after a dream run for 2 consecutive years, the tech funds fell almost by 25% this year. But as an investor, what does this mean for you? Is it an opportunity to invest some more, or is it a time for you to worry? You'll get all your answers in today's episode. Keep watching.
Technology sector has fallen by about 25% this year to be among the worst performing one. But this is not restricted just to India. The sector has suffered massively, even globally. Now there can be two, three factors that can be attributed to it. One is that globally there are big concerns about a surge in inflation, which you would be reading all the time these days in financial dailies. And this surge in inflation is forcing central banks to raise interest rates steeply, and which in turn has led to expectations of an economic recession in the Western world. Now, from the standpoint of Indian companies, this will particularly hit the export-oriented companies hard, because a recession in the US and Europe can lead to a fall in the demand for their goods and services. So that is one big reason. Second is that tech stocks have fallen more simply because they also went up substantially in the last 2 years. After hitting rock bottom in March 2020, when the Modi government first announced a complete lockdown for 21 days, so since then, BSE index bounced back sharply and returned about 60% each in the last two calendar years, 2020 and 2021. And as a result, the valuations of these IT companies, when looked at in terms of their price earning ratios, they more than doubled, or in some cases even more than tripled for many IT companies. And this happened by the third quarter of 2021. Now, on hindsight, of course, one can argue that they had run far ahead of themselves. And as a result, when the markets started to correct, these stocks corrected the most. And then apart from that, the Indian IT companies are also grappling with high employee attrition rates, which is forcing them to raise salaries to retain employees. And this is impacting their profit margins, which are getting hit. Well, that's anybody's guess. We'll only know on hindsight. Rupee has been depreciating against the dollar, and this is a positive for export-oriented companies because the exports become cheaper and more competitive. But as said earlier, if recession sets in the Western world, it will hit the export-oriented businesses in India. Even though the Indian technology companies are projecting healthy order pipelines and revenue growth rates, but that can change if there were to be a recession in the US. So nobody can say that for sure. But the other thing is that most of these should be near-term issues and something that big Indian IT companies can tide over. When we look at longer-term performance, IT sector funds are at the top when we look at 3-year, 5-year, even 10-year timeframes, despite being the worst performers in the last 1 year. So the near-term uncertainties do not take away much from the ability of the tech sector to add tremendous value over longer time frames. Indian IT companies have businesses which have a sustainable growth rates, and barring the likes of Satyam Computers, which was more of a one-off as a corporate scandal, tech sector is otherwise known to have companies and managements which set very high corporate governance standards. So yeah, their long-term prospects are bright. No, I don't think so. And it has got nothing to do with the near-term or the long-term prospects of IT stocks or IT sector at a broad level. My reasons are very different, and it requires some explanation. The foremost reason is that if you have investments already in diversified equity funds, then you already have an adequate enough exposure to the technology sector. It is the second biggest holding in flexi-cap funds, with about an average 10-12% of the majority of flexi-cap funds money invested in technology stocks. So by virtue of that, you already have technology as the second biggest holding in your diversified equity portfolio, and that's good enough to benefit from their upside. The second reason to avoid technology sector funds is, or more broadly any sector fund is, that investing in them and really benefiting from their upside requires a kind of temperament that most retail investors do not have. So better stay away. And I'll cite a study we did in 2020 which further reinforces this claim. Now, of course, though the study is a bit dated and the numbers are a bit dated, but the findings are relevant even now. So we had done this study where we compared the SIP returns of mutual funds with our estimate of the returns that the investors actually make out of them. We did this by calculating the returns adjusted for the inflows and outflows in a fund to derive the investor returns out of a fund's performance. Now look at this graph, which puts some numbers on your screen in terms of the summary findings for three fund categories: the flexi-cap funds, which were called multi-cap back then, the mid-cap funds, and the sector funds. And here sector funds include technology funds, banking, and pharma sector funds. Now, as you can see, what we found through this study was that the investors' returns were much lesser than what the funds had delivered. And that's because investors get in and get out at inopportune times. They invest in a bull run and redeem or stop investing when the markets fall. This behavior adversely impacts their returns. So while the fund fact sheets would show healthy returns, investors' account statements do not show the same. And what we found was that this gap in fund returns versus investor returns is higher in case of categories like the mid-cap funds or the sector funds, and that's because the chances of getting it wrong are even higher in these categories because of sharper ups and downs. Now, while this study captures the data until the end of 2019, the trends haven't changed since then. Even in the big rally in tech stocks in 2020 and 2021, investors did not make as much money as these stocks went up by. Just look at this other graph on your screen for some validation. So as you see now, a bulk of inflows in technology sector funds in the last 2 years, which is depicted by these blue bars on your screen. So these bulk of these inflows came sometime towards the middle of 2021. And this was after the big rally was already behind us. So investors entered more closer to the peak, and that's obviously a recipe for disappointment. And this is not a unique case. This story repeats over and over again. So that's why we always say it's better to stick to the diversified funds instead of trying to ride the sector funds. Now, on the contrary, I'm quite tempted to suggest you to look at global tech sector instead of the Indian IT sector funds. And there are 2-3 reasons for that. One is that they have also corrected sharply this year and therefore are available at more reasonable valuations than they have been in the recent years. When we talk about the global IT sector, what we are looking at are some of the most innovative companies with very strong competitive advantages and a bright future. They also have the pricing power. Think Apple or Microsoft, for instance, which is a great strength to have in inflationary environments such as the current one that we are passing through. Moreover, as an Indian investor, you get genuine diversification by investing in them. The exposure to Indian IT sector that you already have through your Indian funds is of a very different kind. For instance, companies like Google, Microsoft, and Meta, their businesses and their business models are very different from the kind of businesses that you get in the IT sector in India, the likes of Infosys and TCS, where you already have substantial investments. Plus, you also get an international diversification. Therefore, if you are tempted to benefit from the correction in the tech sector, as an Indian investor who's already otherwise invested substantially in Indian diversified equity funds, I think it is better to consider taking some exposure to the global tech stocks. For that, you can consider an index like a Nasdaq 100, which has a significant presence of such companies. Now, there are fund of funds facilitating Indians to invest in them. Some of them are not accepting fresh investments as of now because of the moratorium put in by the RBI. But some others are available for investment. Or otherwise, you can even invest directly in a Nasdaq ETF abroad. But remember, if you do decide to go ahead and invest in some of the global technology companies or technology funds, remember that you need to opt in for the long haul. These stocks have fallen a lot this year and they may be in for more. If the recession fears do come true, then they can fall much more than what they have until now. But still, we don't think it's a bad idea to start building a position by investing in them regularly.
Well, with that, it's a wrap on this episode. Keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel. Take care. Bye for now.